What if the most powerful asset manager in the world, the one entrusted with the savings of governments, corporations, pensioners, and millions of everyday investors, was quietly bleeding billions behind the scenes? What if the company that positions itself as the beating heart of global finance, the one often seen as too big to fail, too interconnected to collapse, was suddenly facing losses so large, so unexpected, and so poorly understood that even experts are stunned? And what if the truth behind those losses reveals something far bigger, something about the global economy, the hidden risks in modern markets, and the fragile architecture supporting trillions of dollars? This is the mystery unfolding around BlackRock today, a company considered the central bank of Wall Street, the invisible hand behind financial stability, the firm that governments rely on when markets spiral into chaos. Yet now, new reports show billions evaporating from its portfolios, outflows accelerating, clients pulling back, and cracks spreading through the very financial systems it helped build. But how did we get here? And more importantly, what does BlackRock's struggle tell us about what's coming next for the global economy? To answer that, we must go far back, because BlackRock's current losses are not simply a single bad year or a rough quarter. They are the culmination of a decades-long transformation in how markets function, how money is managed, and how risk is packaged. A transformation that began in the early 1990s, when Larry Fink, a rising but controversial figure in finance, recognized something other firms couldn't see. He understood that the future of investing wouldn't be about star stock pickers or phone-wielding traders yelling across exchanges. It would be about data, models, algorithms, predictive analytics, systems capable of analyzing millions of variables to guide investments more precisely than any human ever could. Out of that vision came Aladdin. BlackRock's now legendary risk management platform is systems so advanced and so deeply embedded in global finance that trillions of dollars quietly depend on it. Governments use it. Even the Federal Reserve has leaned on it. This dominance positioned BlackRock not just as an asset manager, but as the operating system of global finance itself. But that dominance came with an unintended consequence. The world became synchronized around the same models, the same risk assumptions, and the same playbook. When markets rose, BlackRock rose. When markets fell, BlackRock absorbed the shock. And when investors wanted predictable, low-fee growth, BlackRock's index funds offered exactly that. The rise of passive investing fueled one of the most powerful financial cycles in history. Trillions of dollars poured into ETFs and index funds. Stocks rose simply because they were included in major indexes, corporate valuations inflated, and BlackRock expanded to nearly $10 trillion in assets under management. To many, it seemed unstoppable. To some, even dangerous. No company had ever controlled this much capital before. No single platform had ever monitored this many portfolios, this many markets, and this many interconnected risks. But what few understood then, and what becomes painfully clear now, is that BlackRock's greatest strength also became its greatest vulnerability. Its success was built on a world of stable interest rates, expanding liquidity, predictable market cycles, and a central bank-driven environment where risk felt controlled. But that world is gone. And when the dynamics shifted, BlackRock's largest products, largest clients, and largest assumptions were suddenly exposed. The cracks began forming quietly around 2022 when inflation surged and interest rates began rising aggressively. BlackRock's bond portfolios, once considered rock-solid low-risk foundations, suddenly faced historic losses. Decades-long assumptions that bonds always rise when stocks fall broke down in real time. Every asset class that depended on low rates, corporate bonds, municipal bonds, mortgage-backed securities, long-duration funds, suffered sharp declines. And because BlackRock controls so much of the global bond market, those losses hit harder than anyone anticipated. But the real problem wasn't just the performance hit, was the psychology. Investors who had trusted BlackRock's funds for their steady, predictable safety began questioning their assumptions. Pension funds saw their portfolios sink. Institutions reconsidered their allocations. Retail investors, seeing red for the first time in years, began withdrawing at accelerating rates. Billions flowed out, then tens of billions, then even more. Yet these outflows were only the beginning. What shocked experts was just that BlackRock was losing assets. It was where the losses were coming from. For the first time in modern history, both stocks and bonds were falling simultaneously. The classic 60-40 portfolio model, the backbone of BlackRock's asset allocation strategies, was breaking Interest rate sensitive industries began convulsing. Real estate portfolios, especially commercial real estate, faced severe valuation drops. Municipal debt, once considered safe, began wobbling under budget pressures. And beneath it all, something even more troubling was happening. Liquidity was drying up. Markets that once traded efficiently began showing signs of strain. Buyers disappeared. Bid-ask spreads widened. Leveraged funds were forced to sell assets to meet margin calls. And BlackRock, sitting at the center of all this, found itself absorbing shock after shock. To understand why this is happening, we need to trace the origins of BlackRock's current vulnerability. It begins with the company's extraordinary reliance on passive investing, a strategy that works brilliantly when markets are rising, but reveals hidden dangers when markets reverse. Money automatically flows into the largest companies in the index, giving them higher valuations, regardless of fundamentals. When investors withdraw, the opposite happens. The largest companies face the largest selling pressure. This creates a systemic imbalance. It inflates bubbles on the way up and accelerates collapses on the way down. BlackRock mastered the flow era of investing. Its products dominated an environment where money moved predictably from central banks to markets. But when that environment flipped, the weaknesses became clear. Passive strategies don't adapt, they simply follow momentum. And if momentum turns negative, the entire structure becomes a feedback loop of selling, losses, panic, and more selling. But the situation gets even more complex when we factor in BlackRock's influence over corporate governance, because the company owns significant stakes in thousands of businesses. It became a kingmaker, shaping policies, sustainability strategies, and executive decisions across industries. Now, many of those companies are under strain, and shareholders BlackRock included are demanding answers. In 2023 and 2024, volatility began rising across nearly every asset class. Equity valuations became distorted, with mega-cap stocks absorbing the majority of market gains while the majority of companies struggled. These imbalances created a fragile structure, one where any shock could trigger cascading consequences. Then came the new report, one that shocked analysts, investors, and even BlackRock's critics. It revealed billions in unrealized losses across multiple segments, massive outflows from flagship funds, weakening performance in ESG portfolios, and declining demand from institutional clients. Even more alarming were the liquidity issues flagged in certain bond and credit market areas, where BlackRock is one of the dominant players. These warnings echoed earlier crises, including the 2020 liquidity freeze that nearly halted global markets. Experts were stunned not because losses are normal in finance, but because the scale, the speed, and the interconnectedness of these losses point to deeper systemic fragilities that suggest BlackRock's struggles are not isolated events, but symptoms of something larger. A shifting global financial era where long-standing assumptions are breaking down. So what are these deeper structural risks? They include rising interest rates that crush bond values, shifting global supply chains that disrupt profit models, geopolitical tensions that destabilize markets, demographic changes that pressure pensions and retirement funds, and a new economic cycle where inflation remains sticky, growth slows, and debt burdens rise. This is a world BlackRock was not built for, not because the company is weak, but because the era it mastered no longer exists. The current environment resembles 1994, when bond markets crashed unexpectedly. It resembles 2000, when overvalued tech stocks collapsed. It resembles 2008, when hidden leverage broke the system. And it resembles 2020, when liquidity disappeared overnight. In each of these periods, markets believed they were stable, until they weren't. And each of those collapses revealed a simple truth. The financial system is most vulnerable when it feels safe. BlackRock's losses are not the cause of today's risks. They are the product of them. They reveal how deeply the financial world has changed. They show how fragile the passive investing ecosystem has become. And they expose the uncomfortable reality that even the most powerful institutions are not immune to systemic stress. Now we arrive at the fallout phase where consequences become visible. Investors withdraw. Funds shrink. Valuations fall. Regulators begin examining systemic risks. Competitors look for weaknesses. And retail investors, confused by conflicting headlines, wonder what it means for their savings. And it is being shaped by forces larger than BlackRock itself: central bank policy, global inflation, demographic shifts, geopolitical fragmentation, and the end of the ultra-low interest era. Then come the failed fixes, attempts to stabilize the system without addressing the root cause. Governments inject liquidity but avoid reforming spending. Institutions rebalance portfolios but continue relying on the same underlying models. Investors diversify into new asset classes without recognizing that correlation risks still exist. These fixes provide temporary relief but deepen long-term vulnerabilities. As we conclude this deep investigation, there are 3 key takeaways that every viewer should understand. First, BlackRock's losses are not random. They are signals of a deeper shift in global macroeconomic conditions. Second, the financial world has entered a new era where old models no longer apply and passive assumptions are becoming dangerous. Third, the institutions that once seemed invincible, BlackRock included, are now facing pressures that could redefine global markets for years. So here is the open-ended question. If BlackRock, with all its data, algorithms, and global reach, is struggling in this new era, the warning signs are here, the patterns are familiar, and the next chapter of this financial story is already unfolding. If you want to stay informed, prepared, and ahead of the next big shift, make sure to subscribe. Because the forces shaping as losses today may shape the entire global economy tomorrow, and you deserve to understand them before the headlines arrive.